There's been a lot happening in the housing market and the mortgage interest rate market, and I wanted to share some real data on this. But I've specifically waited a couple weeks to share this video because there's just been so much volatility happening in the markets. And sometimes when we just look at one article or one day, we can't see the full picture. So I've waited a couple weeks to let the market stabilize and settle here so we can really talk about what's going on. And right now, the United States is in trade talks with over 130 different countries. And so anything can really happen. But the tariffs have been really the main highlight, the main headline on the news stream. And there's some validity to it. And we're going to talk about that today. And then also look at some real key metrics that the Fed looks at as to where we're seeing mortgage rates head. And so I just want to show on the screen here, this is the average 30-year fixed mortgage rate chart over the last 1 year. So if we're running a 1 year chart, the reason I'm showing you this, I want you to see the volatility that we've seen in the last 12 months. And so if we scroll back to September, the Fed started cutting rates in the middle of September, and that was the lowest point, about a 6.1%. As soon as the Fed actually started cutting rates, mortgage rates did the exact opposite as we headed into the election. And at the time, going into January, mid-January, we saw a peak of rates at 7.25%. And then Trump administration came in. We're not going to get political here, but the tariffs started coming into conversation, and tariffs were really good for mortgage rates. What happens is when there is risk in the market, money moves from stocks and other risk-based assets and it heads into safe haven assets, one of them being mortgage bonds. Mortgage rates move by mortgage bonds, it's investor driven, and we saw a flight to safety, which really paved the way for Q1. Then we saw administration come out pausing the tariffs, right? We saw some pauses in the news, and then this caused one of the fastest moves up in interest rates just in a quick 1 to 2 week time frame. One of the fastest we've ever seen in U.S. history, actually, because of the pause of the tariffs. And so just a lot of yo-yo effect. This kind of looks like a roller coaster ride at Universal Studios or Busch Gardens or one of those. But just goes to show you that you need an expert in this market because timing is key. If anybody says they can predict the exact time when they can get you the best rate, they're lying. But we can use real data and resources to try to pick when is going to be the best time to lock for a client and then help that client manage the mortgage over the long run. Because if we rewind out 5 years, this chart's a lot different, right? We go back to the 2 to 3% pandemic rates, the fastest interest rate increase in US history, peaking at 8%. But here's what I want you to take away. If we go back, there was an 8% peak in October of 2023. We are now 1.5 years into a downward interest rate cycle. And it may not feel like rates are dropping, but we are in a downward rate cycle over the last year and a half. And so when we go in and we start looking at the rate market, this is a great chart just to show. This is the picture of March and April, right? We had stability in March, volatility in April, and it just goes to show you that we'll have to keep an eye on what happens as we head into May now. But if we're looking at the key metrics that the Fed is looking at, other than the tariffs, inflation is proving to be stubborn right now. What I mean by that is, we had the inflationary time frame in 2022 where we're having more inflation as a country. Now we've seen inflation come down, which is great, but we're not seeing it drop any further. We're seeing it kind of stabilize here or potentially tick up a little bit. And that's been one key to the Fed not cutting rates and for mortgage rates coming down. But we got to keep a close eye on that. The other thing the Fed looks at is unemployment, right? And so we've seen unemployment remain steady. When unemployment is rising, that gives a key indicator that the Fed should start cutting rates. Well, right now we've seen it be steady, and that's keeping rates, in the range where we're at. And if we're looking at, what's the Fed going to do the rest of this year? We're taking the expert probabilities right now. As of last week, there's a 36.9% chance of 4 rate cuts and a 28.1% chance of 3 rate cuts. And so there is a good probability we're going to see 3 to 4 Fed cuts between now and the end of 2025. This changes daily, but at the other end, right now, the key is that we're looking at some rate cuts, but not too many rate cuts because we want to keep stability with the inflation. If we're looking at Fannie Mae, Mortgage Bankers Association, Wells Fargo, NAHB, take the average of all 4. They're predicting right now mid-6s, so that's lower than where we're at, but ultimately it's not quite getting into the 5s yet, but this can change on a dime depending on the article, headline, news outlet, media, etc. Here's the key. Even in an economic recession, generally home sales can rise if mortgage rates decline. And when I hear the word recession, and when I hear people say the word recession, they're feeling the fear and they're feeling like they don't want to make a decision to make a home purchase or to make any sort of financial decision or situation. Now, when we look at the data on this, though, in the last 6 recessions, 4 out of the last 6, we've actually seen home prices increase. We've actually seen home values appreciate even in recessionary timeframes. 91 wasn't a major decrease. The only anomaly of the situation was 2008. Well, let's look back at 2008. We had 3 times the amount of inventory or home supply compared to today's market in the United States. And so if we're looking at basic supply and demand, there is less supply today and more buyers with Gen Z and millennials coming into their first home purchase. The average first time a home buyer age, you're never going to guess this, pre-pandemic was 28 years old. Today it's 38 years old. So we have a lot of people that haven't even bought their first home yet. But in recessionary timeframes, it doesn't mean it's a bad time to buy. There's actually more room for negotiations. And when we look at what's coming, based off the data, in the last 6 recessions, we've seen mortgage rates fall from peak to trough from the entry of the recession to the end of the recession. So every time in the last 6 recessions, mortgage rates have fallen. What do we predict is going to happen if and when we see another recession here this year? I just wanted to share this data with you guys because I feel like it's super important to understand the facts of the matter, not looking at the headlines. But right now is a great opportunity, specifically for buyers. Right now, we're seeing buyers have opportunities to get seller credits, sales negotiations, reduction of prices. We can get creative with buy down programs with interest rates. I've had some clients starting out with 3% and 4% interest rates in 2025 in this market because myself, the real estate agent, and the team that comes behind it, we go and help get a great deal for the client and make it work for them. So if you have any questions or if there's anything specific educationally you want to learn more about, feel free to send it over or email it to me. And I look forward to staying in touch. Take care.